A long, long time ago, I remember when the music used to make me smile. And I knew if I had my chance that I could make those. Oh, sorry, I digress. Had a dream about the day the music died. Good morning, everybody. I hope all considered everyone had a good weekend. I know there's been the velocity of change in our lives over the past few days has been immense. Um, this pandemic is affecting us all adversely or impacting our lives in some way, shape, or form. Um, so I just want you to know that I'm thinking of everybody. We're going to get through this. We're going to unite. We always do. It's a global pandemic, and governments, whether they're responding from a sociocultural perspective or from a monetary or fiscal perspective, are uniting. And we're going to work our way through this, but it's a very trying time for all. And I know we're all acclimating now to social distancing. Um, so we can be prepared to hear that a lot, but it's obviously it's the smart thing to do. Like I said to y'all yesterday, uh, the best thing that we can do is to be part of the solution and not a problem. Sparring over toilet paper and bottled water and stuff like that. We can be positive. We can smile every 5 minutes. Maybe make yourself smile. And overall, just try to remain as positive and healthy as we can be. Get some exercise. Make sure you're eating well. Get plenty of vitamin C. Just anything that with common sense to keep your immune system going. Um, I can talk to people offline on one-offs about that. Should you want to? I wanted to address you. I still need to do my job. Um, we're doing it in a different way, obviously now, and that's another way this is impacting us all for how we work. But I wanted to address you as to what's going on here as we see U.S. futures almost down the limit again. Europe giving up any gains that they had from Friday. There are two things that came out over the weekend that are kind of shaking people up and bringing some reality to the situation. The first thing is the most impactful thing, in my opinion, is an investor call that Goldman Sachs sponsored over the weekend. Goldman Sachs is the gold standard on Wall Street. They are an impact call. They're not the person at the water cooler that you roll your eyes and are like, what now with this buffoon? When Goldman Sachs talks, people generally listen. Sorry, E.F. Hutton. But I'm going to give you a pithy synopsis. Most of us don't have access to that report. I do have access here at JMD. Thank you. And I'll give you a brief synopsis. What's spooking people is that this read like something that I think Stephen King might have had trouble writing. But here's the general gist of what Goldman Sachs says, just so we're all aware and we can put this in perspective. And it's the first time that numbers are really starting to be wrapped around this whole thing. 1,500 companies dialed into this call, apparently. And the Cliff Notes version is thus. 50% of Americans, approximately 150 million, will contract the corona as it's very communicable, like the common cold or rhinovirus. In Germany, which is Europe's largest economy, we heard Merkel say 70% of Germans, it's obviously it's the fourth largest country globally, but it's a big industrial economy. 70% of Germans are expected to contract this. And the peak is to be over the next 8 weeks globally for the virus. It's concentrated in a band between 30 to 50 degrees north latitude, a la like the common cold and flu. It prefers cold weather. So very similar there. Hence, the summer months, particularly in the northern hemisphere, should help mitigate things. Of those who contract, 80% will be early stage, 15% mid stage, 5% critical stage, heavily weighted towards the elderly, as we heard. Early stage symptoms are like the common cold or flu. Mid stage are like the flu, and they are recommending that you stay at home for at least 2 weeks. As a result, they're expecting a 2% mortality rate, possibly up to 3 million Americans. Now, the caveat to this, 3 million people die per year, mostly due to old age and disease. So this will serve as an accelerator, or the coronavirus will, for lack of a better way to describe it, serve as an accelerator with obvious overlap, with some people dying sooner due to respiratory issues. I think the subsequent effect of this is just going to stress our healthcare system. And I got that sense yesterday from talking to a doctor friend of mine who's on the front lines. Thank you, Doc Amy, for what you shared. China's economy has obviously been disrupted huge. Global supply chains are expecting a 6-month recovery there. So you can see the impact or the adverse effect that this has had on the global supply chain. Goldman is expecting global GDP to be the lowest it's been in 30 years, around 2%. And remember, we talked about when we were shifting out of higher growth type equity products into safer investments. We talked about how we felt that even attaining 8% growth to maintain current market multiples would be tough. Well, Goldman's now expecting S&P 500 companies, so the 500 largest companies, to see negative growth rate of 15 to 20% for full year 2020. The glass half full, they expect stocks to recover fully in the second half, and they don't see any systemic risk to the banking system. That was one positive derivative of all the regulation that was put into effect after the housing crisis in 2008. Balance sheets are strong, so the banking system is intact. And finally, they said that, this feels more like a binary event like 9/11 as opposed to a systemic event that affected the banking system like it did in 2008. The second thing that has people spooked this morning, and it's paradoxical, right, is the Fed's emergency rate cut to 0 to 25 basis points on the benchmark Fed fund rate. And they're also going to be injecting $700 billion into the banking system through reverse repos and or buying back U.S. treasuries and other assets. So this is essentially like quantitative easing back in 2008. The difference here is that we had QE 1, 2, and 3, if you remember, right? They had a lot more bullets in the holster. I mean, they basically went broken arrow. So that's scaring people, right? They went a full percentage point on the Fed funds rate. So they went from 1 to 1.25 down to 0 to 0.25. So it's having like a reverse effect now. People will price that in and will reset and will adjust to that. They did this primarily because of oil. You got to remember the shale boom in the U.S. has created a whole economy within itself, particularly in the Southwest, right? Energy companies comprise approximately 22 to 23% of the S&P 500 index. It's a huge part of our economy, as we are a net oil exporter. That's why you see Russia trying to mess with pricing and keep prices, saying, no, we're not going to lower prices, whatever, I'm not going to get into Putin. We all know what's going on there. But what happens when the Fed does what the Fed's doing with the quantitative type stuff is that's injecting dollars into the system, which depresses the price of the U.S. dollar. And the correlation there is a lower U.S. dollar, like commodities are priced in U.S. dollars. So in theory, that makes commodities cheaper. So, people would, buy more oil. But obviously with China offline and, this disruptions globally, that's going to be offset a little bit. So there's in my humble opinion, this is not a monetary problem. There's very little they can do from a monetary perspective. It's a fiscal problem. It's a corporate level problem. It's a psychology problem, which is why markets can't be figured out. 50% of our market is psychology, investor psychology, and just sentiment. So those are the two things that are affecting that. I want to just, from a fiduciary perspective, go over some changes that we made on Friday. As I had highlighted on Thursday, we were going to dip our toes back into stocks a little bit in tranches. So the first tranche, which means we've only just scratch the surface as far as to getting back into stocks, and we're going to sit tight. So what we did was we sold 1 unit of the U.S. Treasury product. We were in the TLT. We reduced 1 unit of the BND, the Vanguard Total Bond Index. Okay, we stayed pat in gold, as I highlighted, and we bought 1 unit of the S&P 500. We bought 1 unit of the QQQ, or the NASDAQ. We bought 1 unit of the XLK, Information Technology Spider, and we bought 1 unit of the XLV, or the Healthcare Spider. I added, from an alternative perspective, I added to Blackstone, ticker BX, a preferred equity. That's my poor man's preferred equity play / real estate play, and I added to the IYR, which is a property REIT product. IYR is the ticker. So those are some changes that we made, reflected. I've expressed that to some of you. We're going to stand tight. We're not going to buy more stocks today on this dip. I'd rather buy them 5 to 10% higher than, get back in. I want to assess, see how markets digest all this news, and we'll take it from there. But again, overall, the most important thing is to remain positive, keep a positive mindset, to stay healthy, eat healthy, try to get some exercise, try to get some fresh air in a smart manner. And I just want you to know that I'm thinking about you all, and I love you all. Take care and have a great day.